Hello everyone, and welcome to another episode of Wealth Talkies by Niyo. My name is Ankur, and I'm a VP product at Niyo. And today we are going to talk about how investors should be reacting to market dips, whether we should be subscribing to all the hot IPOs that have been coming out, and we also want to talk about international equities. And finally, we'll touch upon crypto. And for this, we have with us today Mr. Dhaval Kapadia, who is the Director of Investment Management at Morningstar. The investment management group at Morningstar manages more than $200 billion dollars across the globe, including US, UK, and India, which gives Dhaval a front row seat to all things investment related, not just in India, but across the world. Welcome, Dhaval.
Thanks, Ankur. Pleasure to be here.
Great. Let's start with our first question.
Sure.
Uh, we all have heard this phrase, buy the dip. And of late, it has become even more popular, thanks to cryptocurrencies and all of that, right? So buying the dip, hodling, right? So do you think it even, it applies to a mutual fund investor as well? Like, what would, your advice be? Should investors add more mutual fund units during dips?
So yeah, I think before I directly address that, I think two important or a couple of important things to keep in mind is that the first is your asset allocation, right? I mean, and why do we talk of asset allocation? Why is it, and what does it mean? So asset allocation is nothing but the decision on how much to invest in each asset class. So it could be equity. Within that, it could be large, mid, small. It could be a split between Indian equity and international equity, and then fixed income, gold, even real estate is an asset class. Crypto, obviously, there is a lot of discussion around it, and we'll probably talk of it a bit
Yeah.
later. But then asset allocation is the decision on how you split your money across asset classes, and the reason it's important is because and research has shown this over long periods of time that decision is the key driver of performance in your portfolio over periods of time. So in other words, if you're heavily invested in equities, say 80-90% of your portfolio is invested in equities, it would tend to be more volatile, it would tend to fluctuate a lot, but it should hopefully also give you better returns over the longer term, right? So therefore,
Yeah.
the first thing, to your question in terms of what should you do in market dips, the first thing that you should look back and see is where does your asset allocation stand as of today versus what you were targeting at the start.
Makes
So for
sense.
instance,
Yeah.
if you are an aggressive investor, like I mentioned earlier, somebody is who's got a long-term investment horizon and is comfortable with an equity allocation of say 80-90% in their portfolio. So after this market fall, obviously, because markets have fallen, so the allocation to equities would have dropped a bit, although the markets haven't fallen significantly, but there would be a bit of a drop. So as I was saying that, although of course markets have corrected a bit, the correction hasn't been sharp, about 7-8%, because the last couple of days have seen a bit of a bounce back. So your allocations would have changed a bit, not too much. So, but what you need to see, are you still above your target levels? Say if like I said, you're targeting an 80-20 portfolio, are you still at 85% despite the market having dropped a bit? Then it may not make sense to really add further to your portfolio. But
Got
if
it.
that 80 has come down to say, I'm just giving a hypothetical example, if it's come down to 75-76%, maybe you could add in a staggered kind of a fashion. And and why do I say a staggered kind of a fashion, or through an SIP or an STP kind of a route? The reason is because obviously from the lows of the pandemic, last year, at the onset of the pandemic in March 20, markets have obviously moved up quite sharply. They're up by more than 100%, right? And so
Yeah.
practically they've more than doubled. Small and mid caps have done even all the more better, right? And the markets seem to be pricing in a lot of the optimism, right? So in other words, the obviously the economy is has started to come back fairly well in India and other many parts of the globe as well, and so on and so forth. So some of these are being priced in, but the risks don't seem to be fully factored in. I mean, one is obviously what we read every day about is
Yeah.
Omicron and the new variant and stuff like that. So what could be the potential impact of that on economies, on whether that will impact growth? It may not impact as much as what you saw last year, but at the margin, could it impact demand and so on and so forth? Similarly, high commodity prices or some actions that central banks are taking to cool down inflation, right? Because that's been a factor that's impacted.
Right.
Many economies say in the US, inflation is running at about close to 7%. That's the highest level that they've seen for 3 decades. Similarly, in UK as well, you're seeing inflation at high levels. In India as well, it's fortunately not as high at this point of time. It's about, the core inflation is about 6 odd percent, but still it is a concern. So some of these risks, in other words, don't seem to be factored into the markets as such. And therefore, as I suggested, maybe if your allocation is currently lower than your target, maybe you could stagger your, like I said, buying at dips, yes, but you could do it in a staggered way. If you see a further fall in the market, say, hypothetically, if markets were to fall by another 10-20%, then you could think of, putting in a larger sum at that point of time.
Got it, got it. So, just a follow up to that, and this is a question we get a lot, is,
Yeah.
so should investors, and especially young investors, they're always, this dilemma that they feel that, should they do like an SIP every month, or should they keep, that sum of money aside and invest, when they see so every month, they just keep monitoring the market and invest when it falls a bit. So should it be like
Yeah.
completely automated, like okay, a fixed day a month, or should they take sort of a little bit timing approach that okay, every month I will invest, but I'll pick when I invest, probably when the markets
Yeah.
have fallen a bit, to
Yeah.
get a better
Yeah.
price.
Yeah.
What do you
Yeah.
what do you make of
Yeah.
that?
Yeah, yeah. I'll just take an analogy to that point, in the sense that, in a way, investing, at least, it involves discipline and it involves so many other factors for you to build wealth over a period of time, right? Similarly, if you look at your health, right, obviously you need discipline to be able to really, maintain your health and remain fit and so on and so forth. Right now, you can't say I'll just get up and work out when I feel like, maybe once a month or twice or thrice,
Right,
couple of days a month, I'll exercise for a longer period of time, but that may not work well, right? So I would, just draw that parallel when it comes to investing as well. Ideally, you should be doing, at least a larger chunk of your investments can go through a systematic route, right? And SIP, particularly for most people like us who are earning a salary, right? So, you've got money coming in every
yeah,
month. So I would think that will be the best way to do it, for a couple of reasons. One is it inculcates that discipline, right, in your approach, and you're putting in, small chunks of money every month. And secondly, in many occasions you may not have the time to really, track what's happening in the market. Should you do something or no? You don't want to be on the edge all the time, right? I mean, markets have fallen.
right,
Now should you
right.
invest? Should you wait? So that, as we all say, as the famous saying goes, that, time in the market is more important than timing the market. So from that point of view, I
Right.
think that a regular SIP or STP, as the case might be, I think that's a better way of approaching. And if at all you have a lump sum, and
Okay,
if there is a sharp fall in the markets, you could put that money at that point of time. But otherwise,
got it.
generally, I
Got it.
think a systematic route, would be sort of better, in that
Yeah,
sense.
makes sense completely. Okay, so yeah, on to the next question. And as you spoke about discipline, so this is so I want to talk about the current hot IPO market, right? So
Yeah.
many so many offerings coming in, and I think what is different this time is that now the stocks, the companies that are coming out with IPOs, these are brands that all of us use, right? Which is,
Right.
I think, different, from let's say the last spate of IPOs, and that's, I think, another reason why there is so much of retail participation, right? So, what advice do you have, people investing in, should they, how much should they allocate to IPOs, if at all, people who have been
Yeah.
investing in mutual funds, or just not touch it? Like, what would you recommend?
Yeah. No, IPOs is definitely an interesting space. So, and you can't, paint the brush across and say, all right, you should or should not invest in IPOs. So, I think one has to be more selective, right, in the approach. But one also has to be mindful of the broader market trend, or the broader market perspective in that sense. Now, if you look at, and I was just looking up some numbers in terms of this year, for instance, I think till date there are about 58 IPOs that have come in, right? Out of which about 18 are already trading below their issue price, right? And if I go back and compare this to the last few years, say 2018, 19, and 20 put together, calendar years, there were about 43 IPOs, So
Right.
these were years, particularly the first half of 2020 and 2018, 19, when the markets weren't doing so well, right? Equity markets weren't, in fact, in a couple of the years, they generated negative returns and stuff like that. So the point I'm trying to drive home is that one has to be mindful that a lot of these IPOs come when the markets are in a bullish kind of a trend or a bullish kind of a phase. So therefore, one has to be more conscious and more careful if at all one is looking at investing in these IPOs. Now, if I go back to say 2017, which was a year when equities again did very well. I mean, from 14 to 17, equity markets were performing. Particularly 2017 was a great year, and uh, about almost about 35 IPOs were launched in 2017, out of which 16 IPOs, about 15, 16 of the IPOs, almost 50%, are as of date trading below their issue price. So, in other words, the markets have done very well, but these IPOs have not. So, just to put it into context, and the point I'm trying to drive home is one has to analyze or look at or study some of these companies and not just look at, okay, everybody else is buying, so I should also be putting in money.
Right.
uh,
Right.
Maybe you could do it for
Yeah. Yeah.
for that, sort of, if you want that flavor, you could do it for a certain portion of your portfolio. But the way I would look at it is that your core allocations, your core, part of of your portfolio should be in mutual funds or well researched stocks and companies. Maybe a 5 to 10%, if you feel that, all right, let me test this, test this IPO space, there's so much happening. Maybe you could look at that. But I would be, unless you have a lot of time and you have the resources to really be able to study each of these companies well, because if these IPOs are attractive, if they are attractively priced, and the models are, and the fundamentals are attractive, the business is attractive, and so on, mutual funds also would participate in them, right? So they do participate as well,
Right.
on a
Right.
case to case basis. So by investing in mutual funds also, you will get exposure. It's just that, there is an additional layer of research, and a fund manager sitting up there whose day-to-day job is to track all of this. And
Yeah.
so
Makes
I would,
sense.
like I said, just to summarize, your core portfolio should probably be, mutual funds or well researched stocks, and debt instruments and so on. The satellite portion, or you could have a 5 to 10% in some of these ideas as such.
Got it. No, makes sense. And that's an interesting point that, even mutual funds do invest in IPOs,
Absolutely.
right? So let me just, ask you a quick follow up on this. So see, a lot of people, like, as I said, a lot of brands that we interact with are coming out with their offerings, and which, sort of inclines us to invest in them. So anyway, a lot of retail investors are participating in IPOs, right? So what can we, and we are not analysts, right? We can't do a DCF analysis. We can't, it's
Yeah.
difficult for, retail investors like us to actually look at the fundamentals or read reports and
Correct.
all. And almost every and the other thing is that even if we did, right, almost every IPO will have some analyst who has given a favorable coverage, right?
Yeah.
So in this, can you give us like a rule of thumb? Is there a rule of thumb that, investors can use to increase their odds of success, when they're
Mhm.
looking at investing, even if say 10% of their portfolio as you recommended, right? So is there a rule of thumb that they can use to increase their odds of success when they're investing
Yeah.
IPOs?
Yeah, I think one of the challenges to define that rule of thumb today is that, and which you mentioned earlier, is that most of the, at least this year, we've seen a good chunk of IPOs or companies that have come to issue, come up with an IPO, are essentially companies which are still, loss making in that sense, right? So they are still generating probably negative cash flows, and they don't have, so to derive a valuation, otherwise, one could use, some sort of valuation metric as a rule of thumb, right? But that becomes a challenge with some of these models, right? I mean, you're because they're not profitable. The other way that people look at such companies is to look at, the price to sales, because you can't generate a price to earnings ratio, because the earnings are
Yeah,
negative in
then
that sense,
right.
right? In many of these cases, I mean, we know the big names out there, right? So then people tend to look at, price to sales or price to revenue in that sense as a metric. And I mean, at least, as far as my understanding goes, that, any number that's like a double digit and above, or a price to sales ratio probably would be in a bit of an expensive zone in that sense. So
Got it.
so
But
that's something
yeah,
that I would say. Yes, if a company is profitable, which we've seen, some of these very recently, also last couple of weeks as well, you've seen some companies come in,
mhm,
where the company is profitable. So there you can look at a price to earnings ratio. You can look at some valuation metrics like a price to book and compare them to similar sort of companies within that space or within that segment if available, or to broader markets as well, right? So you could do that. But I think the challenge for, like I said, some of these, obviously many of these tech companies or the new age kind of sort of entities, I think a price to revenue would be sort of a better measure to look at.
yeah.
And I
No,
would
yeah,
be a bit
that's
mindful.
quite
Yeah,
interesting.
yeah,
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 yeah. No,
yeah,
that's quite helpful. So, okay, yeah, let's move on to the next question. So again, we spoke about mutual funds, we spoke about IPOs, stocks, right? So again, extending that a bit, where do you see the role of international equities in someone's portfolio? And let's say we're not talking about HNIs, we're talking about, retail investors like
yeah.
me, our users who are also young. So do you feel that there's a role of international equities there? And what is the best way to get exposure to that?
Yeah, sure. And I think, yeah, international equities, they definitely play an important role. And some of the reasons are, one is, if you look at, obviously India is a growing economy. The equity markets have done well, particularly over the last 12 to 18 months or so. Uh, but whether you look at the economy or you look at the equity market out here, India still comprises a relatively smaller portion of the global landscape. So if I were to look at, say, Indian equity markets versus as a percentage of global equity markets, a sum total of all global equity markets put together, that will be lower than about 3 to 4%, right? US comprises the largest portion of global equity markets at about 55 to 60%, followed by China, Japan, Europe, and so on. Similarly, if you look at the economic size, right? So the global economy as a whole, India comprises, again, about 3% of global, GDP. Again, US comprises about 24, 25%. Japan,
Right.
China, these are also larger. So the point I'm trying to drive home is that, the markets out there are large, the economies are also large, and therefore they do offer, opportunities as well in terms of investment opportunities. Because again, many companies, like you mentioned earlier, we use many of the products, right? Whether it's the Facebooks, the Apples, the Amazons, but not just those, which are today more popular, but then, the Volkswagen or the Mitsubishis, the Toshibas of the world, and the list
Yeah.
can sort of, the BMWs and so on and so forth. I mean, the list can, go on and on in terms of very large companies which have, and multinational companies which gain their revenues and business and profits from across the world. Now, if I were to just pick one example, say of UK, a lot of people talk of US equities a lot, but just
Yeah.
shifting,
Yeah.
their attention a little bit to UK equities, right? So they have an index out there called as the FTSE 100, which is similar to the BSE 100. So which comprises the top 100 stocks or companies that are listed on the UK equity market, right? So 75% of the revenues of the top 100 companies out there come from outside of UK.
Mhm.
About 25% comes from emerging markets, right? So in other words, you're not investing in the UK economy, you're investing in companies that are multinationals, that have businesses running across the world as such. So therefore, the way we would look at this is that, yes, like I said earlier, these kind of companies, many of them may not exist in India, right? So therefore there is a large opportunity set out there. Um, the other aspect about investing globally is that we've seen on many occasions when Indian equities don't do well, and there will be periods, right? It's not just India, but
Yeah.
all
And yeah.
countries, all markets will go through their cycles. So when Indian equities haven't done well, and on many of these occasions or several occasions, international equities have done very well, right? So if I were to take periods such as 2013, or more recently, say 2018 or 19, when Indian equities either generated a negative or a low return, these markets, US equities did very well. Some of the other markets did very well. So in other words, you benefit if you're diversifying your portfolio, right? In the sense that because you'll have these phases when certain markets aren't doing well. But if you're invested across different markets, at least your portfolio is relatively more stable, and you're able to also sort of gain from the opportunities that exist in other markets as such. And just a
Yeah.
final point on that is investing in international equities also provides a hedge against the currency. So what that means essentially is that obviously if the rupee, which even as we speak over the last few weeks has been depreciating. So in other words, versus the dollar, earlier part of the year it was, let's say, about 73, 74 rupees to a dollar. Now it's about 76 rupees to a dollar or so. It's not a very big movement, but there's still some
Yeah.
depreciation. But if you look at it over a longer period of time, it has depreciated year on year, by anywhere between 3 to 4, 5% or so. So by investing in international equities, as the rupee depreciates, you gain further, because for that same dollar, you get more, rupees versus what you were getting, say a year ago or a few years back, right? So it provides a hedge in a way against currency. So again, for people that want to send their kids abroad for education, or they themselves want to go abroad for education, the younger lot, I mean, say over a period of time, and they're saving for that. So this in a way provides a hedge, because then your currency risk in a way gets sort of reduced to that extent. Obviously the equity market risk is still there, but the currency risk in a way gets reduced. So I would say net net,
Right.
I mean, the opportunities, the diversification benefits, and from a currency perspective as well, I think those are some key reasons why. And just to your other point, in terms of retail investors, now there are about, I think today, about 45 to 50 mutual fund schemes that are available, that invest across different markets. In fact, few of them investing in different asset classes as well, like REITs and commodities,
Mm-hmm.
commodity stocks as well. So you've got a whole host of options, investing across the US, emerging markets, Europe, China, and within that some sleeves like just technology, and like a Nasdaq index and things like that. So you've got a whole host of options available. I think it's definitely, if I were to look at proportions, maybe anywhere between 10 to 25% of your portfolio, depending on your risk appetite. One can look at investing that portion into international equities as such.
Got it. Got it. Makes sense. So basically, three reasons, just to summarize for
Yeah,
our viewers. So one is geographical diversification,
correct.
right? Then basically getting access to some growth opportunities that these MNC companies provide, which are today not available in India, and then as a
Correct.
currency hedge, right? So I think,
Absolutely.
yeah, it's a good I think a good mix of diversification benefits as well as growth opportunities,
Absolutely.
right? That
Absolutely.
you can avail of by getting exposure to the tune of about 20%, uh, uh, international equities, and not just look
Correct.
at US, but
Absolutely.
elsewhere as well. Perfect. No, that makes a lot of sense.
Absolutely.
Uh, yeah. So, and yeah, then sort of almost the final question and my favorite for today. So again, extending this to now crypto, which is the
Yeah.
hottest. I don't know, asset class, whatever you want to call it, right? So I just wanted to pick your brains, how people at Morningstar think about crypto, and in particular, Morningstar is a research and investment powerhouse, right?
Correct.
And now today, when we talk of crypto, it's not just cryptocurrencies like Bitcoin or Ethereum. There are also tokens that are coming out, right? Like
Correct.
Sand, Mana, Axie Infinity, Polygon,
Yeah. Yeah.
all of that. So are they the new stocks? Now we have more than thousands of them, right? So
Yeah.
is
Absolutely.
someone like Morningstar should start researching them, like how they research
Yeah.
stocks? Like, do you think there's a white space there? Do you have plans? How does it all
Yeah, I
look
mean, I
from
think, see,
inside
that's, yeah.
Morningstar?
So that's a question, and that's a great question in today's context, right? I mean, given that there is so much interest in on the crypto space, and the question that we tend to ask ourselves is that when we are looking at any asset class, right? And like you said, should we start including it in our? Should we start doing more research around it, and study it and include it as part of our asset class coverage, or whatever it is, or from a research perspective? The first question that we tend to ask is that what is the role of any asset class in your portfolio, right? And typically we see, asset classes tend to have one or two roles. One is, does it help from a return generation point of view? Can it add value in terms of returns? And secondly, does it help in terms of diversifying my portfolio? We've been talking of diversification for a bit now. So, what role does it play in the portfolio? Now, if I were to look at crypto from the first perspective, it is in terms of return, generating returns. Obviously, we all know it's done exceptionally well, at least in recent times, right? But the question that crops up is that, how do you value that asset class, right? If I were to try and look at it, like we spoke of equities earlier, that in terms of valuations and things like that. So how do you value an asset class like crypto? Because the challenge is that there are no underlying cash flows, right? It is not unlike in case of equities where you have dividends, you have earnings. In case of bonds, you have coupon. In case of real estate, at least commercial real estate, you have rentals and things like that, right? But in case of crypto, there are no underlying cash flows, right? So to try and derive a fair value, now who is to say what's the fair price for any of these cryptos that you mentioned today, right? So in other words, it is largely driven as of now by demand and supply, right? In fact, our researchers team was just looking this up, and the number of cryptos available, right, is and which is tracked by coinmarketcap.com. There are about 15,000 cryptos
Wow.
that are being tracked. So that's a humongous number, right? So from that point of view, uh, if you go back to the point that there are no underlying cash flows, it is driven primarily by demand and supply, right? It's demand. If there is a lot of demand, the price will go up. If But if you've got so many cryptos available in the marketplace, what does it say for demand and supply, right? It's very difficult to determine that, right? Because if something goes, you could buy into any of these, thousands of cryptos that are available in the marketplace, right? So from that point of view, uh, you know, as a portfolio manager or as an investment manager, it's very difficult to determine, on what basis should you include crypto in your portfolios, right? So that's from a return perspective. The other aspect is what we discuss in terms of diversifying or acting as an inflation hedge. Now there is an argument out there which says that because and this is a little bit technical in that sense that the monetary system that is running in most economies, whether it's US or Europe or to a certain extent some emerging markets, is is flush with money, right? Is flush with currency in that sense. The balance sheets of these central banks have expanded a lot. So therefore, as an alternative to some of these fiat currencies, crypto, which is not which, although there are a number of cryptos, but then it's not as heavily supplied as some of these currencies. Can it act as an inflation hedge or as a diversifier? Now, the challenge with that is that you don't have enough history to really be able to prove that, right? We've seen on many occasions when equity markets haven't done well, some of these cryptos have also come off and things like that. So from that point of view, I would say there isn't adequate history to be able to make a judgment whether, like to take a different example is gold, right? The history that you have in gold is much, obviously, going down thousands of years, but even periods over which it was tracked more closely as an asset class, you at least have more history. You are able to see what it does in different market cycles and so on. So does it react differently to other asset classes in one's portfolio and things like that? So at least from our point of view, I would say that this is the view that we hold at this point of time. We are still not able to see a strong reason to really include it within our for the reasons that I mentioned, that we aren't convinced that it how do you derive value for any of these cryptos, right? Who is to say what is the fair value of any of these cryptos? And like we said, we aren't also convinced about its diversification benefits at this point of time, at least.
Fair enough, fair enough. But so right now, it would be fair to say there is no crypto team at Morningstar.
Yeah,
Like
there
there's
is.
no crypto
But like I
research
said,
team.
yeah. That's for sure. You can say that. But like we said, our investment team keeps an eye out for opportunities, right? And tries to look at each of these asset classes that And what I was trying to discuss is what are the merits and demerits in a way, right? I mean,
Right.
of crypto as an asset, or it's difficult to call it as an asset class, but as something that's as an investment
Right.
opportunity that's available. But yeah, I mean,
But do you think like it could be something like how initially when the internet companies came, right? No one knew how to value them,
yeah,
right? And some things of that sort again happened with SaaS companies, right? People didn't know how to value subscription-based businesses, right? So they were fairly undervalued for a long time, right? So do you think something like that is happening here? There is absence of a model, but that's not evidence of it not being monetarily valuable.
uh, I know what you're saying, but if you look at even the examples that you gave, the internet companies, you're right. I mean, that's one of the reasons why you saw, you know, the first IT crash in say 2000, 2001, because people weren't sure people overvalued many of these companies, assuming that they will generate significant cash flows over the future and so on and so forth. But at least I would say that there is, even in these companies, there is an underlying model, right? In the sense that there is a business. Now, how do you value the business is definitely, like you said, it's not an easy task, right? Today, I mean, I would say that's common for so many stocks and companies, right? How do you really, what is the price that you'll pay for those kind of companies or stocks? But at least there is an underlying business that you can track, right, over a period of time. Is this, say a Paytm or anybody else, how is their subscriber base growing? How are the underlying cash flows growing and so stuff like that? So there are some metrics that you can track. And these businesses, all said and done, over a period of time, will generate cash flows. Now, whether those are positive, negative, I mean, that's a different story. But they will. So there is some underlying, cash flow that you can track over a period of time, right? But again, in this case,
Got it.
that
Yeah.
becomes. I think it's a similar. I wouldn't say this challenge is just true for crypto, but it's a similar challenge for gold, right?
Exactly. Exactly.
Because
Yeah.
gold
How do
also
you
is,
value gold?
yeah, it's very difficult. Yeah, we only use some sort of, based on historical trends, we tend to use, and based on how gold has reacted or performed in different market cycles. Say when interest rates were high, what happened to gold? When equity markets, or there was a lot of economic uncertainty, what happened to gold prices at that point of time? So we use some of these parameters, but in essence we tend to use the interest rate and the inflation differentials to try and build some sort of a, value for gold. Or I wouldn't call, there's no precise way to do it, but some indicative sense of what the potential fair value could be. So say if I were to look at,
Yeah.
if I were to, because gold is essentially priced in US dollar terms, right? I mean, then it gets converted to, so it's traded in the global markets and so
Yeah.
on and
Yeah.
so forth. So then we would look at, what's the inflation or the interest rate differential between India and, US in that sense. So, things like that, and then we use that to try and derive. Uh, but
Yeah.
that's a similar
I
challenge
think
because there
what
is no underlying
helps.
cash flow that
Yeah.
gold generates.
Exactly. I think what helps there is just the amount of history that is available. So, you can use that to come up with some sort of empirical model to value
Yeah,
gold. Because just the amount of
yeah,
history that is available,
exactly.
which is today absence in crypto, which is what you were referring to. There's no history, so we don't know how to, even from a diversification point
Correct.
of view, how to make sense of that.
Exactly.
No,
Exactly.
I mean, that is, yeah, amazing insights, Dhaval. I think that's all we had for today.
Okay.
But yeah, I mean, amazing, as I said, to get the view from, one of the best minds in the country on investment and research.
Sure.
And I hope you also enjoyed the session.
Absolutely.
Yeah, so awesome. And thanks everyone for watching, and stay tuned for our next episode of Wealth Talkies by Neo, where you can get your investment questions answered by industry experts. This is Ankur
Sure.
signing off. Bye.
Thank you. Thanks, Ankur.